Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy.
Good morning, everybody. It is just now 10 o'clock on Tuesday. That means it's time for our Tuesday morning webinar. Happy Tuesday, everybody. I think I said happy June last week, but it's okay to say it again. So happy June again. Boy, it's been super duper hot outside. I'll share with you while everyone is logging in that yesterday morning I was ready for a 7 a.m. bike ride, and I went outside and I wanted to beat the heat. I had a flat tire on the back wheel of my bike. You cyclists out there, a flat's no big deal, but it's just a little extra effort when it's in the back. But I got it fixed up and I headed out, and within 0.76 miles I had another flat on the same tire. So I had to hang up my cycling ideas for the day, and today's no better because it's supposed to rain this afternoon. So hopefully that doesn't happen and I can get out there and work to stay healthy. So good to see everybody. We've got a normal schedule this morning, but let's get started. It's now 10:01. So there's some general announcements that I'd like to give you for our clients and our folks who are looking for our help. So Jessica in our office is on a well-deserved 2-week vacation. If you call into the office and you hear a new voice, that new voice may be Hamiko. Hamiko has now been with us. Well, I know she's been with us over 100 days because we just did our 100-day follow-up with her. So she's been with us for a while, but she's had limited client interaction. But Hamiko is a wonderful person. She's based in Florida. I think you've heard me talk about her. If you need us, we all answer the same line, so it's okay. And everybody, of course, has my mobile number as well. Next week, we will be in Texas for 3 days at a training event. So Wednesday, Thursday, Friday. Next week, we will be checking email and answering calls periodically. Again, as we've learned over the past year, we can work from just about anywhere. So we're going to be doing some training and procedural things with Kestra, but then we're also going to be doing some internal work within the firm as well. But our phones ring to our mobile phones as well as our desk phones, so you can reach us if you need be. I just ask for a little bit of patience, but listen, if you need something immediately, let us know. We'll get it taken care of for you. We did start our summer hours, so on Fridays we typically leave at 3 o'clock. I'm available usually after that, but just want to give you some guide of where we are right now. I'm really looking forward to getting back in the office in July. So I'm not sure how long that'll be because we are thankfully moving forward with some renovations. I just had some nice progression late in the last week. So it may be that we're moving out again in August or maybe before, but I'd really like to see that office work done by the end of the year so I can have you all come visit for an open house. It's well overdue. Okay, I think that's all the announcements for just general housekeeping announcements. I do want to remind everyone that you are recorded, of course. You're muted. You do have the function for raising your hand or asking questions, so please take advantage of that as we go. We do have some upcoming special webinars. So our first special webinar is tomorrow night at 6:30. I know you've all received emails. I apologize for the multiple emails. I have a typical schedule I stick to because, believe it or not, even though we send you 5 or 6 emails for each one of these webinars, I still get people to say I never heard anything about it, so I didn't get the email. So if you're already registered, you don't have to worry about it. We have a lot of people registered already. But tomorrow night we'll be discussing using annuities in retirement planning and Roth conversions. So annuities can be a really complex topic. We're going to take as much time as we need. If we need to do another follow-up, listen, I'll tell you that I remember when I started at what was then Payne Weber, I had a long conversation with a fella who was in my training class, and he had worked at Merrill Lynch for a little while before. And he was telling me about annuities, and I just couldn't quite grasp how they worked, what they were, what the basis were, the entire process of these things. And there's so many different styles and types. So it took me really a good amount of years to understand very well how they work and what their pros and cons are. So we're going to go over that as much as we can tomorrow night at 6:30. The next special webinar will not be until the end of June, and that'll be fiduciary assistance for powers of attorney, trustees, and executors. So you should be on this webinar if you're any of those, a power of attorney, a trustee, or an executor. If you're an attorney, you should, and you deal with powers of attorney, trustees, and executors, I would ask you to also attend. It's very beneficial for your clients. And that's on June 30th, also at 6:30. And of course, if there's anyone close to you who is a power of attorney, trustee, or executor, he or she should attend that webinar. On the 21st of July, we're going to talk about investment fundamentals. What are stocks? What are bonds? What are these ETFs or exchange traded funds? What are mutual funds? How do they work? What are the pros and cons? We may touch on annuities again in there. And then on the 28th, we're going to talk about the reality of the 4% rule. Many of you have heard about the 4% rule. If I withdraw 4% of my savings over my retirement, I should be okay and not outlive my money. That is a very dangerous assertion. So we want to go through what the meaning of it is for you. All right. Let me just check my no questions. Okay. So as I always do, I'm going to go through some updates. So I have an interesting little update or information from the Ed Slots mailbag, as they call it, that I think would be interesting for you folks. And then I go through analyst reports. And today we're going to talk about, in our planning section of this, we're going to talk about dollar cost averaging. Or sometimes called DCA, dollar cost averaging, not just investing in dollar cost averaging strategy, but also withdrawals and what that means. So it's very important, and it's something that's not talked about enough. So we're going to dig into that a bit. So let's look through our Ed Slot updates first. So I thought this was a really good one. This was about Roth conversions and 401ks. So I'm going to read the question to you. So this was the question from a financial advisor who attended one of the IRA seminars that Ed holds. And he writes, hi, I attended the February 2021 IRA seminar and had a question regarding Roth conversions. The seminar discussed rolling over assets held in a company plan into a Roth IRA. I'm dealing with a client who wants to roll over a lump sum from a state pension plan into a Roth IRA. Can you tell me, in your experience, if this is generally permitted, assuming taxes paid on the conversion amount? Thank you in advance, Patrick. So the answer, this is the Ian Berger is writing this one from Ed Slots Group. The answer is, hi, Patrick. Lump sum distributions from tax qualified retirement plans, employer retirement plans, can be rolled over to a Roth IRA. A state pension plan will qualify as a tax qualified plan. That tax qualified plans fit in that middle bucket, that tax deferred bucket that we often talk about. Moving funds from the plan to a Roth IRA is a conversion, which is a taxable event. So what did Ian just say there? He said, yes, of course, you can roll that pension directly into a Roth IRA, and the entire amount will be taxed in that year, which is a taxable event. And this is very important because here's a fella. I'm glad Patrick has attended this an IRA seminar, but I hope he goes the next step, joins our group, becomes a member of Ed Slots Elite Advisor Group, and will really understand the best way to handle this. Unless this pension is very, very small, it probably makes more sense to roll that into a traditional IRA. You take your lump sum pension, you roll it into a traditional IRA. That is not a taxable event. Now you can decide on what schedule you're going to convert. because once you take those funds from your pension, lump sum pension, roll it into your traditional IRA, let's just say it's $500,000. You're not, now that $500,000 is sitting in a traditional IRA. Rolling it from a pension to a traditional IRA, again, is not a taxable event. Now, let's just say you want to convert $100,000 a year for 5 years over to a Roth IRA. Well, is that conversion taxable? All of you should be nodding your head. Yes, the $100,000 is taxable, but you're controlling the tax. You can look at your tax liability. You can look at how much that tax is going to cost you. We have really good planning and pro forma tools for that. So you can see what the percentages and what the dollar amounts are going to be. And you can decide how much you're going to convert each year instead of just rolling it right into a Roth IRA. And now suddenly $500,000 is taxable. And that can affect a lot of different things. We've talked about IRMA, right? Your additional amount that's adjusted for Social Security. There's tax credits can go. There's all kinds of things that can be. I said Social Security, I meant Medicare. There's all kinds of things that can go away. So that's a really great question, but it opens up a lot of other questions. So good start, Patrick. I hope you stay with it. Another question, if you're an employee who participates in a 401k and you are a non-owner employee and retire at, for example, age 73, many people are working longer. I was speaking to a gentleman yesterday who just retired at age 70. His wife is not going to retire for a few more years. She's 70, 72, I believe, and she's still working and going strong, and that's great. So if in this example, if you retire at age 73, do you have to take an RMD in the year you retire? Or can you take your required minimum distribution at RMD by April 1st of the year following retirement? So we know that if you're still working and all your funds are in your 401k or a retirement plan, then you don't have to take those, and you're not an owner of the company, then you don't have to take those required minimum distributions. But the question is, once you retire, when do you have to start taking those required minimum distributions? Now that's only in the company plan. If you have IRAs, you still have to take those required minimum distributions, whether you're working or not. The question goes on to say, if you can take your RMD by April 1st of the following year, does that mean you have to take 2 RMDs in that year? So the answer is, if you delay your RMD beyond age 72 under the still working exception, the first RMD is due for the year you retire. So as soon as you retire, if you retire on December 31st, you've got to pay a required minimum distribution for that year. You can defer the RMD for that year until the following, because it's your first one, until the following April 1st, but then you would have to take 2 required minimum distributions in that year. Be careful though, Ian goes on to say, if you want to do a rollover of your 401k funds, any RMD must be taken before the balance can be moved into an IRA. So if you do a rollover in the year you retire, the RMD must be distributed prior to the rollover and cannot be delayed until the following year. So most custodians are good at that. They handle it, but you've got to make sure that it's done. So that's something we certainly check on when you're talking about people who are over 72, over the required minimum distribution age, and make sure those are done. So that's just an example of a lot of the information we get from the Slack group. It's always good to stay on top of these things. I try to bring it to you, so these are top of mind for you. While we're talking about RMDs, I think we're going to see a shift in the age again. It went from 70 and a half to 72, about a year and a half ago. Now there's discussion in Congress to take that up to 75. I don't really see any reason that won't pass. So I expect by the end of the year, maybe by this time next year, that we'll see those required minimum distribution ages jump up again to age 75. It makes sense. Nothing saying you can't take the distributions, but it's life expectancies are getting longer. We have to make these adjustments. Okay. Just checking for questions. No questions. Okay, so where were we? Where did we close on Friday for the week? I get a lot of feedback, positive feedback on this. People seem to like this. So the week ending June 4th, that was my daughter's 15th birthday. We had a great fun day. The Dow Jones Industrial Average ended just up 0.69%, and that makes it 14.5% for the year. So really solid returns still year to date. Year over year, of course, much better, 34%, almost 35%. The S&P 500 is up for the week. Really all the major indices that we track other than the bond, the 1 to 3 year bond index, were up. And year-to-date returns are very strong. The NASDAQ is one of the lowest, and that is up still 7.51%. Listen, folks, anytime we're crossing over the 6 and 7s, it's a good year. So if we hold this for the rest of the year, then we should be in good shape. The 10-year Treasury, which that's the 10-year government Treasury bond. That's we talked about that a lot so far this year because a lot of volatility there as interest rates go up. Well, it's stabilized over the past week. We were at 1.59 a week ago, and as of June 4th, we were at 1.55. Not bad. So we see a lot less volatility right now because of interest rates. That can change at any given time. And just so you know, I'm just looking at the screen. The market's kind of split right now. The Dow Jones is down a little bit. The NASDAQ's up a bit. Lots of volatility to be had, I believe, for the rest of the year. A lot of uncertainty. So, just keep paying attention to your statements, your online access. And if you have questions, reach out to us. We are always looking at opportunities within changing our investments and any rebalancing that we need to do with clients, tax loss harvesting, things like that. So, I love these MFS by the numbers reports, and there's, just a handful of tidbits I pulled out for you. But I thought this was interesting. So they talked about the last year over year. So going into the 2021 Memorial Day holiday, the S&P 500, the top 500 companies in the U.S., was up 12.6%. So because I just told you that we're up a little bit more than that now, about 14.5%. Going into last year's Memorial Day holiday, the S&P 500 was down 7.8%. So, now looking back, it really turned around really quickly. It kind of feels like, I don't want to minimize the effect of COVID. For crying out loud, we lost over 500,000 people. But now as we're getting back out into the economy, we're going into stores, mask restrictions are being eased, people are getting their vaccinations. It's just, it's becoming much easier out there. But we saw a really fast turnaround in the markets, considering that people were struggling. We had many people out of work. A lot of reasons to be very negative about it, but the market turned around very, very aggressively. And that was because, as I said before, of the government, what I call backstop. The government basically stepped in and said, we're going to push out everything that we can to keep this economy afloat and to keep the markets afloat. And, they did a really good job of it looking back. Now it's costly. And that's the next point. The Fed's balance sheet reached $7.33 trillion as of the end of May. That's up from $3.8 trillion as of February 2020. So, that's more than a doubling. So that just means the amount of bonds that the federal government owns. The result of new purchases of the U.S. Treasury. So the government's issuing bonds and they're buying them back. So now we collectively own $7.3 trillion of debt. That's a staggering number. And we knew that we were going to get there. And we knew that, some of our other concerns were going to happen over time, but things have been accelerated quite a bit. And there is some progression as we've been paying attention to the American Jobs Plan. So it's gone from $2.3 trillion of spending directed to infrastructure to $1.7 trillion. And there's a counter proposal last week of $928 billion. So we'll see where that lands. So that's having a great effect from what I'm hearing about keeping the costs of materials up for construction, because there's this massive spending that's going to come into the markets. And when I say the markets, I'm talking about the housing markets, the building trades and all that, because that just doesn't seem to be slowing down. And as I shared with you, the folks who are in the business have told me that their suppliers think that this is going to continue to increase for the next 5 years. I don't know how a homeowner is going to be able to do any work. I just want to get my work done quickly, as quickly as possible. And I complained about having to do my roof suddenly last year, but boy, am I glad I had to do it last year and not this year. So how about West Texas Intermediate crude oil? So that closed at $33.71 a barrel on Thursday, May 28th, 2020. So a year ago, a little over a year ago. Well, that as of May 28th, 2021 was $66.32 dollars a barrel. So it's a 97% price increase. So that's significant. We're seeing that at the pumps as well. Now, I'll tell you, that is more in line with probably what it should be from a profitability point of view for energy companies. So if you're an energy investor, you've got to pay attention to that. But it doesn't mean that, we've had a lot of other things come into the market. Natural gas, that's replaced a lot of need, potentially for oil. So the question continues, well, where should the average price of oil be? Is it $66 a barrel? Is it $90, $100 a barrel? Or is it really somewhere in that $33 a barrel? And then there's, political pressures as well around that. So an interesting piece of information. So be careful when you're picking your energy sectors there. How about inflation? We've talked a lot about inflation over the last 25 calendar years. From 1996 to 2020, the cost of living adjustments for Social Security benefits has increased 68.3%. So they've increased. So from 1996 to 2020, they've increased your Social Security benefits by 68.3%. Given that same period of time, though, how much has the inflation increased? Well, 69.7%. That's not bad. So inflation increased just a bit more, 1.4%, but your Social Security increased 6.83%. Not bad. I have to give credit to the Social Security Administration, or whomever decides the increases, because that 1.4% over a 25 calendar quarter or 25 calendar year, is pretty significant as far as being close. And we know that Medicare covers 61.2 million Americans are age 65 and over. There is a proposal from President Biden that he discussed during his campaign to lower the age of Medicare eligibility to 60. So that move would projected impact an additional 20.8 million Americans, and that's from the Kaiser Family Foundation, is that information. Now, I feel a couple different ways about that. First of all, one of the struggles that people have who come to me when they want to retire prior to age 65 is, how do I pay for healthcare coverage? And the average healthy individual will probably pay somewhere between $1,200 to $1,500 a month in healthcare coverage at that age. If you've got some health issues, it could be more, but that's a good guide. And that's for an individual. So husband and wife, multiply that by 2. Now, there may be some COBRA opportunities. COBRA can be more expensive, but the coverage can be better. So they're the things that you have to weigh. I have a really good resource for that. You've all seen him, this fellow, Steve Bobrin, who's been on these webinars before. But, there's a cost to that. So while I like having that coverage for my clients, there is a significant cost. We know that Medicare is already scheduled to run out of money, their trust fund, in a very short period of time. So I believe it's 2024 now off the top of my head. And that is just right around the corner. So giving eligibility to another 20.8 million Americans would accelerate that troublesome date also, because we all are concerned about Social Security. But if we've talked one-on-one, or if you attended my classes or attended these webinars for a while, Medicare is 5 times larger than Social Security. So that's a concern. So good and the bad there, right? That's why we have to plan for these tax efficiencies. And great segue, BlackRock is talking about concerned about taxes. Now they're concerned in other areas, but they say, I've never been much of a forecaster. The fellow who wrote this piece says, but it seems difficult to have a conversation with advisors or friends that doesn't end in a prediction about what future tax rates will look like. Listen, I don't know how our taxes are not significantly high. This is me saying now, I don't know how our taxes are not significantly higher in a very short term. And a very short term is within the next 10 years. All the studies I've shown have shown us that, or all the studies I've read and all the work I've done has shown us that your average middle-class American is going to be somewhere in the 40 to 45% effective tax rate. And that's at least double where your average middle-class American is now. As you go up the scale of income and assets, it's just going to increase. So BlackRock says there's no need to panic, but I am concerned. And there's no need to panic, but there is a need for action. So these are the days when we need to take action. It's important to have a plan in place. It's important to work through that plan. It's important to review that plan. And it's important to know all the nuances of the plan and to understand the cost and the benefits. So yes, it costs money to do things like Roth conversions now. But if we are still in historically low tax rates, why in the world wouldn't you do a Roth conversion in 2021? Many people missed an opportunity to do them in 2020 and prior to that, and they wish they would have had those opportunities. So it's all about managing it. So BlackRock goes on to talk about pay attention to your investments, pay attention to capital gains distributions. We talked about capital gains a few weeks ago. Capital gains distributions. Doesn't make sense to use mutual funds or exchange traded funds. Doesn't make sense to invest in IRAs or Roth IRAs. So they really got down into the nitty gritty here a little bit about the use of exchange traded funds and tax efficiency and doing tax loss harvesting. And we could talk about that in the fundamentals of investments, but there's so much that goes into tax efficiency. It really, a lot of it is about the buckets. We talk about that, your taxable bucket, tax deferred, tax-free bucket. But then within that taxable bucket, there are components that are going to be better or worse for you potentially, as you know, giving tax efficiency. So, and there are things you can do, tax loss harvesting. So that is simply when you sell something throughout the year for a loss, and you can either write that off at the end of the year, offset it against other gains. You can, an individual can deduct up to $3,000 a year off of their income, or you can 100% set it off, offset it against gains, depending on where those gains are. But sometimes it makes sense to sell a loss. Now, if we all would have known what was going to happen with the markets and you had taxable accounts this last year, you could have sold, waited 30 days, rebought positions, and had a nice loss that would have offset any gains. So I'm getting a little bit into the weeds there, but that's basically what BlackRock's saying. So I'm going to wrap up this piece with Riverfront. So again, Riverfront being a strong investment group out of the Richmond, Virginia area. I don't invest with them, but I really appreciate their commentary. And they're talking about Europe. So BlackRock last year overweighted Europe, thinking that Europe was going to come out of the COVID crisis better than the US, and it was the exact opposite. So that was a bad choice for BlackRock, and one of the reasons I don't believe in overweighting, underweighting positions, sectors, and whatnot. But Riverfront is saying Europe from consummate slacker to candidate for most improved. U.S. still the strongest economy, but Europe blatantly catching up. So they're just talking about there are 4 areas that are still behind us, but they're still they're beginning to see improvements. The vaccine distribution, business sentiment, stimulus and lending, and earnings momentum. So European economies are blatantly catching up to the U.S. We believe this is due to increased vaccinations and stimulus, and the region is now improving enough for us to consider adding some exposure. So that's good. So we have international exposure, including Europe. They've been suffering over the past year compared to the U.S., and it'll be nice to see them see that area come up. Now, the U.S. may lag compared to Europe when we're talking this time next year. And does that mean that we should be loading up our money in the European markets and pulling back our money in the U.S. markets? Well, only on a natural rebalancing, because again, we believe in strategic allocation. We believe you should have access to all these markets, these areas, and these sectors, but they should be based on strategic asset allocation, which tells us for a certain amount of return, we get or a certain amount of risk, we get a certain amount of return. I'm not a believer in overweighting any area, making thematic investment changes or thematic investment decisions, or basing on what you believe may happen, because I find that the risks are much greater and the gains are incrementally more. And for me, it doesn't make sense. Okay. Let me just check to see if we have any. No questions. Okay. Let's talk about dollar cost averaging. So I'm going to switch to my whiteboard. And let me make sure that everybody, oh yeah, I'm sorry. We have two questions. Gerard asks, is there a better time of the year to do Roth conversions? I'm taking income monthly from a qualified annuity. Gerard, it depends. I would say this: do it as early in the year as possible, because then you don't have the issue with trying to get it done at the end of the year. However, if you have uncertain income, then you're probably going to want to wait till the last quarter of the year, because if you receive bonuses, if you're working longer than you think, or you just you don't know if your income is going to be higher or lower. Well, lower is not a big deal, but higher is a big deal. You cannot undo Roth conversions anymore. We don't have recharacterization. So if you're comfortable in what your income is going to be for the remaining of the year, no reason to wait. Make sure you pay your taxes when you're supposed to. Don't wait until April 15th of the following year. If you do them in the first quarter, you want to make sure that you're making estimated payments, or that you pay it when it's due, if you're not withholding for that tax payment. But the reason it may make sense to do it earlier in the year is that if you continue to have growth throughout the year, then your growth is going to be in the Roth IRA, not in the traditional IRA. So good question. Now, on the other side of that, the markets could drop, right? So you could do your conversions at a higher level, but then the markets drop. And that becomes a little bit of a timing issue. Some people like to do multiple conversions throughout the year. And an example was in June of last year, we did a lot of conversions for many clients, and I staged it. I said, I don't think we need, for most of them, I don't think we need to do the entire amount now. Why don't we do half, a quarter, 3/4, whatever it was appropriate for that client, and then we'll do the remainder at the end of the year. Now, looking back, of course, it would have been a much better strategy to convert it all for the year in June of last year or May of last year, but that was an unknown, because the market could have continued to go down. Great question. Laxman asks, how does one protect your investments from rising inflation? Really great question, Laxman. The typical thought is you protect your investments from rising inflation by investing in stock equity portfolios, because the stock portfolios should climb higher than inflation. Now, of course, there's risks with that. So to get a higher amount of return and something that's going to increase over inflation, you're going to have to take a degree of risk for that. And the degree of risk that fits for you may be different than the degree of risk that fits for me. So that's where the work has to be done. Now, there are other things. There are principal protected vehicles. And we're going to talk about that tomorrow night on the special webinar at 6:30. Principal protected vehicles. There are inflation, the TIPS, the Treasury inflation securities. There are floating rate funds that interest with rising interest rates. Then the rates will also increase in bonds. So there are. Just like anything, it's typically a combination of things. Now, what I find that works really well, Laxman, is a Taking all of those things together. Asset allocation, like we talked about before, make sure that you've got all of your funds allocated where they should be, given what your needs, objectives, and feelings about the markets are, feelings about risk, um, and making sure you've got the best components available for those little pie charts in your allocation. Then you also want to have a portion that's principal protected. So you have opportunity for growth, but you're not going to lose any money in the markets. The third part of it, and very, very important, and where most people don't get involved or don't understand it, or it's too much work, because it is a tremendous amount of work, is account segmentation. So that is making sure that you've got your funds in the places they need to be and invested the appropriate way for the time of your life. So that helps with rising inflation, because you've got exposure to the stock markets, and you can pull that money out of those more volatile portfolios if needed. And it grows for use in a time when you're going to need it. Now that may not be for the next 10, 13, 15, or 20 years, or maybe never. And then the money that you need in the short term is invested appropriately so that there's minimal volatility. So I'm happy to go over that one-on-one with you, but really two great questions. And I didn't mention this when we opened, and I apologize, but there are, at the end of this event, you're just like any event, my calendar will populate, and you'll have the opportunity to schedule time with me if you have questions. Now, again, if you've already had the 1 hour consultation or 50-minute consultation that I offer, and you want to have another one, reach out to us. We'll schedule something for you, and we'll discuss the details on that. I don't want people taking up my calendar multiple times. That's not fair to my clients and others who might be. Now, I'll tell you, this week my calendar is full, so I've got some availability over the next couple of weeks. Okay, let's move on to that whiteboard. Good questions, everyone. All right, I'm going to share my screen here. And as I always ask you, just raise your hand if you can see my whiteboard now, and you should see something that says dollar cost averaging, and some other things under it. Okay, thank you, everyone. Okay, so I'm going to be looking down, so don't take that as offense. I'm going to be drawing on this and referring. So we're going to talk about dollar cost averaging here and what that means. And we're going to talk about it not just for investment, but also for withdrawal. So here is a definition from Investopedia. So Investopedia.com is, I refer to it often with you, but this is, I'll just make this a little larger. Anybody can access that. I like websites that everyone can access. And this is a good, simple definition. So dollar cost averaging refers to a practice of dividing an investment of an equity. This is using equity. So that equals stock in this example, into multiple smaller investments of equal amounts spaced out over regular intervals. The goal of dollar cost averaging is to reduce the overall impact of volatility. Volatility is risk, right? On the price of the target asset. So that's very fancy, just way to say the investment. As the price will likely vary each time on the when the periodic investment is made, the investment is not as highly subject to volatility, right? Risk. Dollar cost averaging aims to avoid making the mistake of making one lump sum investment that is poorly timed with regard to asset pricing. So let's talk about what that means. Let me just make this smaller again, because it's into my notes. Let's move it out of the way. Okay. So very simply, I'm going to use this as an example. I had a client roll over a $200,000 CD, and we're investing this money into Roth IRA. It's already a Roth. We're investing into a Roth IRA. So that's tax. This is for this purpose. This designation is not important. So there's a couple different ways we can handle it. We can take $200,000 and we can put it right into the appropriate portfolio. So assuming this portfolio is appropriate for the client, this is the appropriate investment, we can put it right into there. Now, let's just say today is 6/8. Whoops, this thing's really sensitive and moving all over. 6/8/2021. And let's just say the majority of it is in the U.S. stock market, just for simplicity. And the Dow Jones Industrial Average today is trading at 34,000 right now, 575. So we take the $200,000 and we put it in today, and it's all invested in 100% stock in different areas, right? That's why we have the pie chart, but we're going to use this number as a guide. If 6 months from now, the Dow Jones Industrial Average is worth $36,000 and everything else has followed suit, then that was a good decision, wasn't it? The answer is yes, right? So this is June. This is always complicated to me for some reason, but I think December would be, we're going to use December, doesn't matter, 2021. So that's good, right? So this growth is good. Now, what if we took the same $200,000, and I know this is very basic, and we put it into the same portfolio, and we've got the same amount here. This is the Dow Jones Industrial Average. And now on 12/8/2021, the Dow Jones Industrial Average equals 24,000. What if we have a big significant drop again for some reason, right? Or let's give it the same. Let's not be crazy. Let's give it the same couple thousand points, 32,000. So what is that? Well, that's bad, right? So that's not as good. It may not be bad, but it's not as good. So how do you mitigate that? How do you deal with that? Well, one way is some people just say, that's okay. I understand that my investments are going to go up and down, and at the end, it should be more up than down. Well, mathematically, it may make sense to do what's called dollar cost averaging. So what if we took that $200,000 and we invested in the same appropriate portfolio, and we started at what? 34,575. That's the Dow Jones Industrial Average. And in June 8th, we took 1/6 of that 200,000. So that's 33,333. And we invested at 34,575. So now let's draw this over 6 months. So we're going to do June, July, August, September, October, November, December. We're going to go to December. Is that 6? 1, 2, 3, 4, 5, 6. So that's 7. That's 7 full months of investing, but 6 months. But because we're going to invest in June. So in June, use 34,000 as the starting point, and we're just using the Dow Jones Industrial Average as an example. So we take 33,000 and we invest here. And now let's say in July, the Dow's trading at 35. We take 33,000 and invest here. Let's say though in August, I should have left myself some more room. It's trading at 32,000. Well, we take 33,000 and invest down here. Now let's say in September, it's trading at 36,000. We have 33,000 invested here. And you can see as we progress. Now the benefit is, and like I said, I'm just going to create room. That's the magic of a whiteboard in this little line. We're going to bring this down a little bit more. So we have June, July, August, September, October, November. And we're just going to go to November. But what if we hit these areas and we've got the same 33,000, and then let's see, we're in September, October, 33,000. And at the end of the year, towards the end of the year, we hit 30,000 and we got 33 here. Well, you can see that instead of just investing at one point, you've bought into the portfolio here at several different points. And as we go, right, we're kind of all over the place here. What we're going to have is we're going to have an average of that. The average line is actually going to come down a little bit more, but we're going to have an average. So that is what they call dollar cost averaging. So the average price, instead of being buying the Dow Jones at 34,000, it might be, given it whether it's higher or lower, you might have an average price of buying the Dow Jones at 33,000, because you've got some at 34, you got some at 35, you got some at 32, you have some at 36, and then 30 and 31 and 30. So your average price might be 33,000, which is obviously better than buying it all at 34 and then ending up at the year here at 30. And now all you're seeing is a loss. You're still going to see a loss, but it's going to be a much lower loss because you're going to have different purchase points. I see a question, so I'm going to pause. Luxman just said, thank you for your answer. You're welcome. So it can certainly make sense. Now, I like to use, when I'm dollar cost averaging into an investment, I like to use 6 months. I think a year is probably too long. It takes a little too long for your dollars to get working. And for the most part, you're going to see the same volatility over 6 months as you're going to see over that year period, but you're going to be invested much more quickly, in my experience. So I think my point is, I think you're going to get the benefit of dollar cost averaging in a shorter period of time, probably the same or close to the same benefit as you would investing over a year. Now, there are drawbacks. As I said before, if you take that $200,000 and it just goes up, well, listen, if you would have invested that $200,000 in June of 2020 and just let it go, you would have had a great 6 months, a great 6 months, maybe to the tune of, 25 to 30%. That's a percent. Now, if you would have dollar cost averaged, maybe you did, 10% or maybe 5%, because you're buying it all along this line. So it can work against you. I had a client, I remember him saying many years ago, I every time we do this, we dollar cost average, it always works against me. It depends on what your goal is. Is your goal to get every single nickel of every potential return, or is your goal to minimize volatility? And we're talking about really risk, right? Most people that I work with, this is their goal. I have to tell you, if people's goal is to get every single nickel of every return, they're not a good fit for us. It's just, it's never going to work in the long run, because there's always going to be something. Even if they get a 30% return in a year, they're probably going to say, well, geez, I could have had 35 if I just did this and this. So, but most people come to us and say, we want to get a stated return, right? An assumed return. For most people, that's somewhere between, 6, 7, 8%, but then they're ecstatic when we get to tens. But most of all, they don't want to increase risk, or they don't want to lose what they have. So that's why dollar cost averaging works for most of our clients. Now, it may not work for you, and that's okay, but that's the benefit. So that's from an investing point of view, how to ease into the markets, because many people are still saying, well, the markets are all-time high. What do I do with this? What do I do with these funds? Well, it could make sense to average into it. There's no reason to take this full $200,000 and just plop it into the market, unless that fits into your plan. Now, sometimes that's $2 million, right? You have people retiring with a 401k. You have pension lump sum distributions. So, this is where this gets much more complicated. This is where you should be segmenting those accounts. But for something that's going to be especially equities based, stock based, the dollar cost averaging can make sense if you're concerned about the risk. Okay, so now what about, that's investing? What about withdrawals? I don't know if you folks can hear my dog barking in the background. We have and if you do, I'm just going to tell you a story real quick because we have, I'm a little over, but that's okay. Um, um, we have a big German Shepherd. He's 115 pounds, and a week, 2 weeks ago almost, he had to have emergency surgery for his back. It's been a really troubling situation in our household right now, but he is in a crate for another few weeks. And my wife is out, who usually takes care of the dog barking, because I'm still working at home. And he's barking in the background. So my apologies if you can hear it. Gerard made a really good point. Most every working person that contributes to a 401k derives a great deal of wealth investing monthly. And yes, that means that you've got your 26 pay periods, and every pay period, some of your money comes out and goes into your 401k. That is dollar cost averaging. You've been dollar cost averaging into your 401k from an investment point of view. Withdrawals are just as important. You're age 65, you're retired. Now you're saying to us, I'm just laughing because of this dog barking. Now you're saying to us, Mark, where's the money coming from? I've got maybe a pension. At 65, you're not collecting Social Security yet, probably. But we have to start taking distributions from our savings accounts, whether you're IRAs or whether you're your taxable accounts, and probably not your Roth IRA yet, but maybe. So let's say you have $2 million sitting here in your overall accounts, right? And they're all invested. If you're with us, you're going to have multiple accounts that are all invested differently, right? So if let's just say that this is your first segment, this is segment one. Even segment one, I like to dollar cost average out of it. So let's say you have $300,000 in segment one to cover your first 3 years of expenses. And we know, simple math, right? You're going to need $100,000 a year, but does it make sense? So let's just focus on this section here, this segment here. Does it make sense just to January 1 to take $100,000 out of there and put it in your bank account? I don't think so. Why not take $25,000 a quarter? That's what we like to do. We set up quarterly distributions. They come out, go into our client's account, whatever that number is. It doesn't, $25,000 is an example. $25,000 a quarter goes into the account, because even though this portfolio here is set to be minimal volatility, you're still going to have some swings, right? You're still going to have some swings in that portfolio. So if you take $100,000 out here, and then the portfolio increases, well, you've missed out on some growth. If the portfolio drops, then you're the smartest person in the world. But you don't have to make that decision. You can take it over that year and smooth it out. Again, most people want to make sure that their money's going to be there when they need it, not to squeeze out every nickel of return. So dollar cost averaging coming out of your portfolios is just as important as investing in the portfolios. All right. I hope that gives you a general idea of dollar cost averaging. That is our discussion for today. Not seeing any other questions. I want to thank you all who attended. These webinars continue to grow, and I really appreciate that. And I know many of you are sharing them with your friends. I appreciate that as well. I'm looking forward to seeing you all tomorrow night at 6:30. We'll talk about annuities and how they work into retirement plans, if they work or not. And we'll see you all again next Tuesday. Have a great week, or a great day. And for those of you that I'm not going to see tomorrow night, have a great week. And for those of you who will be on tomorrow night, I'll see you tomorrow. Take care.
Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.